So, you've done everything right. You've worked hard, you've saved diligently your whole life, and you're ready for retirement. But what if that very success, that nest egg you've built, actually sets you up for a nasty surprise? We're going to dig into a hidden financial trap that catches even the smartest retirees off guard. I know, it's a pretty scary question, right? You followed all the advice, you maxed out your 401k, you built this fantastic retirement plan. But what if there's a hidden flaw in that plan? Something that could end up costing you thousands of dollars when you can least afford it. And that's the crazy paradox we're exploring today. The reward for all your hard work and successful saving can actually be a recurring, frustrating, and frankly infuriating tax bill that pops up right when you're supposed to be enjoying your life. Okay, let's dive into this. We're calling this a surprise because, well, it acts like a silent, unwritten rule of the financial game. It's one of those things that isn't obvious at all until it's too late. And it catches even really financially savvy people completely off guard. So the key that unlocks this whole trap is a weird little calculation called provisional income. And listen, this isn't your normal everyday income. It's a very specific formula that the IRS uses, and it mashes together your adjusted gross income, any non-taxable interest you have, and, here's the most important part, half of your Social Security benefits. Now, here's the thing. This trap isn't something you choose to fall into. It's more like a chain reaction, a domino effect that's actually triggered by the very retirement accounts you worked so hard to fill up in the first place. And that very first domino to fall, it's called the required minimum distribution, or RMD for short. To put it simply, once you turn 73, the government says, okay, time's up. You have to start taking money out of your tax-deferred accounts, like your 401k or a traditional IRA. And no, it is not optional. And you can see how this plays out, right? It's like clockwork. First, you hit that magic number, age 73. Then the RMDs kick in, forcing you to withdraw money you might not even need. And finally, because that forced withdrawal counts as income, your provisional income just spikes. One step leads right to the next. Let's just look at an example to see how dramatic this is. So here we have a retiree. Before RMDs, their income is $100,000 a year. But once they're forced to take an $80,000 RMD, bam! Their income, at least for tax purposes, shoots up to $180,000. They didn't need the money, but now they're stuck paying taxes on it. And that creates a whole cascade of other problems. Yeah, that income spike doesn't just create one problem. It delivers this brutal 1-2 punch with two separate and pretty costly tax consequences. The first hit is something people call the Social Security Tax Torpedo. When your provisional income is low, you're in the clear. Your benefits are usually tax-free. But as those RMDs push your income higher and higher, you cross these invisible thresholds, and suddenly up to 85% of the Social Security benefits you've been counting on are now taxable. And just when you think it's over, here comes the second punch, Medicare surcharges. That same RMD-driven income spike can trigger these nasty things called IRMAA. Think of them as extra premiums, a surcharge you have to pay every single month for Medicare. So let's get this straight. Your income tax bill is higher, and your healthcare just got more expensive too. And we are not talking about chump change here. This number you see on the screen, that's per person. So for a married couple, you could be looking at these surcharges adding up to nearly $700 a month. That's a real painful hit that chips away at your retirement savings month after month after month. Okay, so that's the problem. And yeah, it's a pretty big one. But this isn't about doom and gloom. The good news is that if you plan ahead, there are absolutely strategies you can use to sidestep this whole mess and take back control of your money. So the million-dollar question is, how do you actually do it? How do you disarm this financial time bomb before it goes off? How do you stop your own savings from working against you? All right, the absolute key is to manage your income before those RMDs start. One of the most powerful tools is a Roth conversion. This is where you strategically move money from a traditional IRA over to a Roth IRA. Yeah, you pay taxes on it now when your income is lower, but then that money grows and can be withdrawn completely tax-free later on. Another tactic is planning which accounts you pull from and when. By taking money from different buckets, like a taxable account first, then a tax-deferred one, you can carefully manage your income level year to year. Both of these strategies are all about shrinking the accounts that RMDs will eventually target. Smart timing is also a huge deal. For example, if you can delay taking Social Security, you keep your taxable income really low in those first few years of retirement. And guess what? That creates this perfect window of opportunity to do those Roth conversions we just talked about. And for anyone who's charitably inclined, there's a fantastic tool called a qualified charitable distribution, or QCD. This lets you send your RMDs straight from your IRA to a charity. The donation satisfies your withdrawal requirement, but, and this is the beautiful part, it never hits your tax return as income. Now, in the spirit of full transparency, the source material for this explainer actually comes from a guide put out by a financial advisory firm. So naturally, it frames all of this as a pretty complex landscape, and it emphasizes that navigating these kinds of choices is often best done with a professional. And really, this all brings us to the final and most important takeaway here. When you're up against these kinds of hidden, complicated financial rules, the single most powerful defense you have is a proactive plan. And here's the bottom line. Building up that big nest egg is really only half the battle. The ultimate defense against this tax trap isn't just about how much you saved. It's about having a deliberate, thoughtful strategy for how and when you're going to use that money in retirement. And that leaves us with one last question to chew on. We've just pulled back the curtain on one of the tax code's hidden rules. And it really makes you wonder, doesn't it? What other silent rules, what other financial assumptions might be out there shaping your future right now without you even knowing it?